principal at McCready & Keene. His background includes over 15 years in the retirement industry. He is responsible for the delivery of quality service when providing actuarial and retirement benefits consulting services, in addition to installing and administering custom retirement plans to McCready & Keene clients. And he also serves as the primary financial officer for the Retirement Services Division of the One America companies, responsible for financial reporting, pricing, expense management, and profitability. And he has been the executive sponsor and business leader for American United Life's entry into the pension risk transfer space. American United Life is a flagship insurance company of One America and entered the pension risk transfer market in January of 2014. So without further ado, I'll go ahead and turn the presentation over to our panelists, Mark and Andy. Welcome, everybody.
Thank you, Krista. I'm happy to be here today sharing this information with everybody that's on the call. Today we're going to provide a brief review of the pension risk transfer process and a walkthrough of an example on how it was implemented with one of our clients. I'm sure everybody knows what pension de-risking is. So briefly, pension de-risking is categorized into 3 separate sections. A benefit solution, which helps manage the risk associated with the plan liabilities. An investment solution, which helps manage the risk associated with the plan assets. And a pension risk transfer or settlement, which removes the risk associated with assets and liabilities. Most plans will incorporate several of these de-risking strategies throughout the life of the plan. Most of these strategies can be utilized regardless of whether a plan is ongoing or frozen. As we can see here, here's a full spectrum of common de-risking strategies. Today we're going to concentrate on the settlement or pension risk transfer strategies of the spectrum. Implementing a pension risk strategy will require strategies from the funding, investment, and benefit sections as well.
Mark, I see that we have our first question here. If we can get a response on the question is, how much impact does changing the plan benefits have on the ultimate cost of the plan termination?
Mark, I'll take that question. This is Andy. Well, depending on how much time you have to implement a change, it can be fairly significant. And clearly, lump sum and early retirement subsidies have a significant impact on both the cost of the plan and the cost of the plan termination. Other benefits that you may look at would be death benefits and disability as well.
Thank you, Andy.
Now that we've seen what de-risking is, we want to start considering the next logical questions. So, what risk do I want to look at, eliminate, reduce, and when is the right time to review these options? The last decade has clearly identified the risks that have the greatest impact on the perceived funded status, and those are the interest rate and investment. Mortality and the active regulations have changed really the expenses for the plan sponsors and has created the volatility within the pension plans on the balance sheet and cash flows.
And I see we have another audience question. This question is, how do insurance companies view these risks, and how would they manage these risks differently than a plan sponsor?
This is Andy. Well, certainly life insurance companies have experience in both mortality and investment. Insurance companies tend to manage the investments by purchasing high-quality bonds that match the cash flows of the plan. So if a plan sponsor was following an LDI strategy, that would be fairly similar to what an insurance company would be doing. And then as far as mortality, that's something that we're very comfortable with. Both in the pension side and the life side. So we would be pooling mortality of a number of different plans together to share the risk and reduce the volatility.
Thank you, Andy.
This slide may seem like common sense to most of us. The best way I think about this slide is associating it with driving directions. You may know where you want to go and who you need to pick up along the way, but if you're missing a few of the steps of the directions, it may take you some time to get there. In the PRT process, starting with the wrong assumptions, information, or contributors may make it nearly impossible to identify the right options. Going back to a question that we asked a few slides ago. So when is it the right time to analyze these PRT options? There is no time like the present. Timing is extremely important throughout this entire process because many of the variables are dependent on market conditions. The planning and analysis phase can take months to complete. The planning phase will be responsible for develop clear and concise goals and objectives, set the parameters for the analysis, define the milestones and deliverables, and identify the contributors and stakeholders.
And I do see we have another audience question. When you say starting the planning process immediately, do you mean at a certain funding level or when we are contemplating plan termination or something else?
I'll take that. Funding levels and the contemplation of termination are important factors, but there are only aspects to be considered when the objectives of the client is defined. In order to create any type of action plan, the organization must understand what the market value of their liability is. And to understand that today will help them put a plan in place for guidance for the future.
Great. Thank you, Mark.
As mentioned in the previous slide, the planning stage will identify the contributors and stakeholders. These contributors will most likely be the advisors of the plan today. The team of advisors, along with the plan sponsor, will collaborate to identify and provide the necessary information, set the parameters for assumptions, and monitor the process to ensure that we are all working to obtain the objectives developed earlier. This group will certify that information, organize it, and use it to determine what options are available. The values of these variables, as explained, are very time sensitive and are related to market conditions. Therefore, the results that come from this analysis is a snapshot of the cost at a point in time. Lastly, there are other risks, usually not considered in calculating the liability. These risks need to be quantified and factored into the overall equation in determining the options and timing.
I see our audience has provided us with another question. This question is, how will the new mortality table impact the value of the plan liability and cost of annuities?
I'll take that one. I think for most insurance companies, they've factored in the mortality improvements that are in the new table. So it really shouldn't impact the cost of annuities. What it will impact over the next 2 to 3 years are both the way plans are valued, the liabilities are valued on their financial statements, and ultimately will impact the calculation of the lump sums. So it will have a significant impact, and we'll talk about that a little bit later.
Great. Thanks, Andy.
I know a review can be quite testing, and thank you for bearing with me on the pension risk transfer review. The following slides are from an actual presentation to a board of directors, except the names have been changed to protect the innocent. I'm sure that everyone participating today has either experienced or knows someone that has experienced this roller coaster ride. Our client has experienced the same sensation. And frankly, the price of this ride ticket has been too costly for them. They see the regulatory winds changing and the cost of the protection insurance, PBGC costs, contributing to the volatility of future costs. This is why they decided to take on this endeavor now. As I explained, they want to look at the cost of removing some of the risk today versus the cost of managing the risks over the next 10 years. And with the help of all their advisors, compare those costs to formulate what options are available to them. Let's review the plan specifics. The plan has assets of $41.7 million. They measure their liability by book liability, and the present value of the plan benefit obligation is $50 million. The cost to terminate the plan and purchase annuities for all participants is $59 million. The difference between the annuity costs and the lump sum value for the term vesteds and actives is a difference of $6 million. The plan liability consists of 45% retirees, 55% of deferreds, or term vesteds and actives. Moving on to the next slide. One of the strategies above is to offer term vesteds to actives and lump sums and purchase annuities for the retirees. This has been a common strategy in the market, and Andy's going to take you through the comparison of these strategies.
Thank you, Mark. We're going to step out of the case study just for a moment to talk about how liabilities are valued and how they should be compared to the cost of purchasing annuities and lump sums. And they really will illustrate and reinforce the points that Mark has already made. Given the time that it takes to prepare for a full plan termination, there's going to be a lot of volatility in the amount of cash that's going to be required at different points in time. Your actuary can give you an estimate now, but it may be very different a month or a year from now. This is why working with a firm like Dietrich, as well as your actuary, can help you keep tabs on this amount and know when the time is right to do a transaction. The other key takeaway is the liabilities you are holding on your financial statement do not likely reflect the full economic reality. The true cost comparison of cost to PRT should be the difference between the annuity premium and the economic liability. And let's look at the retiree liability first. And if you look at the slide, the first bar shows some various things that aren't typically taken into account when you're considering your financial liability. The first of is expenses, administrative and investment expenses. That's represented by the green. That's over the life of the plan, could add as much as 5% to your liability. The PBGC premium, as you know, that continues to rise, and we've estimated the known cost, but the other factor is what will that cost be in the future, which is clearly unknown. And finally, represented in the red is the mortality improvement that I spoke about earlier. Depending on the population, it could have an impact of 5 to 10% on the economic liability over the life of the plan. So altogether, if you add all those impacts up, your true economic liability in this case is more like 118% of your financial liability. So there's natural volatility that becomes with these results as well, which we really haven't even reflected. One important consideration is offering lump sums to retirees. While this slide really suggests that's a no-brainer because it illustrates that you could get off your risk at 95 cents on the dollar, the reality isn't so clear. If a plan has offered lump sums to retirees, chances are the least healthy of those retirees will take them. Insurance companies call that anti-selection and will typically increase the premium on the remainder to reflect the remaining retirees are in aggregate healthier. And then you can see if on the bottom bar chart the buyout for this scenario is 116%. So if you compare the gap or the economic liability, which when you total up all those impacts is about 118%, the buyout cost looks fairly comparable. And going to the next slide, where we're talking about deferreds, they're very similar, but there's a couple of key differences. And one of those is in the top bar, there's an additional section for early retirement and optional forms. And this is where a plan that has a lot of early retirement subsidy or offers lump sums at retirement, that can add significantly to the economic cost because and those may not be fully represented in your financial liability. Then going down to the lump sums, you can see the range is even wider on lump sums. In that gray area in the middle bar, 2014 it appears to be a pretty good year to offer lump sums. The rate is higher than it was in 2013, which means the lump sum payments are lower. And then when you combine that with the actual yields that we're seeing for 2014 and the prospect for a lower discount rate in 15, it makes it even more attractive. Finally, depending on the plan, as I mentioned, there's optionality as it relates to early retirement and optional forms. And typically, insurance companies charge a fairly hefty premium for those kind of uncertainties as it relates to participant decisioning. Mark? Mark, I'll turn it over to you.
Thanks, Andy. To the next slide. As part of the planning stage, the client was troubled by trying to pick one set of assumptions in how the assets and liabilities would perform in the future. So we gathered up the team and had a collaborative decision on how to measure those assets and liabilities, and a decision was made to use 3 different scenarios for the next 10 years. Those scenarios are listed above. We wanted to make sure that all the costs were included in those scenarios, which not only included plan contributions, but it included all their fees, as well as the possible termination costs. Looking at the 3 scenarios, the baseline, or the most probable scenario, is highlighted in orange. Starting at the top of the results, and here we're looking at millions of dollars in after-tax contribution for the plan, because that's really what the board was interested in. To terminate the plan now on an after-tax cost basis and offer the term vesteds and actives lump sums, the after-tax cost for the baseline scenario would be $8.8 million. Now, you see a 5% savings. That 5% savings assumes that 50% of the participants, terminated, vested, and active, would take the lump sum. We were being conservative here. The 7% represents 70% of that same group selecting the lump sum, and the 0% represents purchasing annuities for everybody. Then we wanted to look at the 3 different scenarios and look at what's the potential cost. Here, we took the present value of those future cash flows and then discounted it with after-tax, using the after-tax benefit. And looking at the 3 different scenarios compared to the cost to terminate now, you see the results below. In the worst case scenario, it's going to cost the plan sponsor an additional $7 million in after-tax dollars today to stay in the plan over the next 10 years. On the baseline scenario, it would cost an extra $2.8 million. And in the best case scenario, the plan sponsor would save $1.6 million. In comparing the termination now with the status quo or the leave as is, there are clearly some economic advantages to doing something with the risks associated with this plan. Moving that risk to a third party. The above chart shows if a plan leaves, if the plan stays as leave as is course, when will the accumulated annual costs have a break-even effect on the upfront dollars of terminating the plan now? So, as you can tell, the different scenarios would have different break-even points, but I think the important thing to show here is that all the scenarios, there is a break-even point. Lastly, we're looking at the options under the plans. Again, all this information was gathered, it was put together. Now what are the options? Well, the options are to continue the plan as status quo. So leave as is and defer that cost of the plan throughout the next 10 years. There's a partial settlement or partial buyout today in which the plan sponsor would purchase annuities for the retirees today, open up a window to offer lump sums to the terminated vesteds, and continue to make contributions for the remaining participants for that 10-year period, or as economic conditions change, maybe terminated at a later date. This is what people may know as kind of right-sizing a plan. So transferring the liability that's associated with the legacy liability, the people that no longer work at the company, and only keeping the liability of those active participants. Lastly, we looked at terminating the plans today. And filing for termination and waiting for proper approvals, and then purchasing everybody, or offering lump sums and purchasing all the rest once the approvals are done. Again, timing is a critical factor here because those variables, interest rates change, asset values change, which can change the cost of each of these scenarios along the way. In looking at the different options, we also want to look at what happens to the risk, because the objective all along has been, do I transfer risk today, and if so, at what cost, or do I keep the risk? So if the plan stays as status quo, the plan retains all the risks we discussed previously. With the partial buyout or the partial settlement, the plan risks are transferred at the time of the buyout and at the time of the lump sums, for those that do select lump sums, to a third party, whether that be an insurance company or the plan participants themselves. The plan retains all the risks associated with the active participant, but the overall risk of the plan is reduced proportionately to the amount that is settled. In the last option, terminating the plans, the plan risks are retained during the termination process. Once the lump sums are implemented and the annuities are purchased on the remaining participants, all risks are transferred to a third party.
Mark, I just wanted to emphasize on the partial buyouts. There's a lot of work going on in that space. In fact, our own company is considering doing a partial lump sum for deferred vesteds, where we limit the window to participants who have less than $75,000 in lump sum. So we're trying to maximize our benefit and cost savings, and also make sure we don't run into any unintended consequences on accounting.
Andy and Mark, we do have another question. The question is, does purchasing annuities for retirees in advance of termination increase the cost of the remaining liability?
This is Andy. I think the short answer is it depends. I think every plan is different. That's where working with an advisor like Dietrich is critical, and working with your actuary. I mean, for small plans, I think it's probably best to keep them together, but it's not a requirement. Some insurance companies prefer to work strictly on retirees, but there's plenty of insurance companies who will consider just deferred blocks. So I think you just have to strategize with your advisors.
Great. Thanks, Andy.
Thanks, Andy. I'd like to add one thing to that, is that it goes back to the objectives of the client. So since timing is a critical aspect, depending on how large your retiree population may be, they may want to lock into that cost prior to termination, so they know that cost has been locked into. They may not lock into the terminated vesteds or actives, well, the actives because they haven't hit a distributable event. But for most likely, they're going to offer those people lump sums during the termination process. But at least they can lock into a cost today, especially in this volatile market. The last slide here is the advisory group consisting of the following plan advisors. All analysis and decisions were not made in a vacuum. They included everybody in the group. When the appropriate group of advisors incorporate the appropriate plan and economic information, then the right solutions can be presented to the plan sponsor and the board of directors. And this sample, or this example, utilized that process throughout.
Great. Thank you, Andy and Mark. It looks like we have a few additional audience questions we'd like to address, so I will go ahead and share them with the group. The first question is, why would a plan sponsor considering offering lump sums to participants prior to plan termination?
I'll take that one. Well, I think it really has a lot to do with the basis of upon which the lump sums are being offered. As I mentioned, 2014 compared to 2013 is a more attractive year to do that. And a lot of times you can't predict when your plan termination will be finalized. So it's and if you have to wait too long, for example, if you went into 2015, it might not be nearly as attractive. So by doing a lump sum window in advance of plan termination, you get to control the timing.
Great. Thanks, Andy. Our next question is there a preferred method for offering lump sums, i.e. via one-time window or adding as an option under the plan? And why are insurance companies shying away from bidding on plans with unlimited lump sums as an option under the plan?
I'll take the first question. Is a window or is a one-time window preferred to just adding it to the plan? And I think the answer is absolutely. You get to control when you offer lump sums and when you stop offering lump sums, and so I think just from a control standpoint, windows are very much recommended. As far as whether insurance companies shy away from that, I don't know if they shy away from it as much as they charge more for the fact that they're not sure when they can't predict what the cash flow of the plan is going to be, so there's more risk. So some insurance companies do not bid on those, but I think by and large you can still get good quotes on those.
Great. Thank you again, Andy. Our next question is, in your case study example, what was the circumstance for your client to look at these options now?
Over the last several years, regulators have made it extremely clear that these plans are no longer in favor. The latest regulation, the increase in the PBGC premium, and the introduction of the updated mortality has significantly increased the expenses and liability of this plan. With these increases and the uncertainty of the future, our client determined that now was the right time to start looking at this. They've been contemplating it for years, but it finally decided, let's go.
Great, thanks. And also, why did the client choose 4, 6, and 7.5 as their average rates of return?
Another statistic of the plan here is the client has already implemented an investment strategy called dynamic de-risking. This involves the asset side, and is defined when the plan sponsor becomes better funded. They move from less risky or more risky assets to less risky assets. The plan has historically earned an average of 7.5%. So that was the obvious choice. But as the plan becomes better funded, either through investment returns or cash contributions, the expected rate of return for the plan is projected to decrease. 4% represents the current return on investment-grade bonds today, and 6% was used because it's a rate somewhat in the middle, closer to what they've been earning on average.
Great, thank you, Mark. And we have a few more questions. The next one is, are returns the only thing that impact break even?
I'll take that. I think it's referring back to slide 18. As I'm sure everybody knows on this call, is that there are several variables that really determine funded levels of the plan. Interest rate, mortality, rates of return will all have an impact on the break-even point.
Terrific. And we have another question here is how would you describe the state of the SPGA market, and are you seeing the interest from your clients, from your DB clients?
I'll take that one. I'll answer the first part of the question. How would you describe the state of the SPGA market? Well, I think it's a dynamic market. I think there's several insurers, including ourselves, that either have entered or are looking at entering the market. Still a pretty small group of insurers. So I think there is some concern that if big transactions such as the GM transaction came through, that might impact the capacity of the market. We haven't seen that so far this year. I think one thing about the market is over half the transactions occur in the fourth quarter. So firms that can do a transaction outside of the fourth quarter may have a better likelihood of getting more competitive quotes, but it just depends. I mean, this market is very sensitive to returns, so it's hard to predict when is the best time to be in the market. I think the best thing is to be ready to be in the market when you can be, and that's why the planning and all the things Mark talked about are so important. Second part of that question, if I remember it, was, are you seeing interest from your DB clients? Absolutely. We just this week we had a client who wanted to do a lump sum window before the end of the year, and 2 weeks ago we had a similar client, and I think that's one of the things that you need to be aware of is a lot of the actuarial firms and the firms that are working on these transactions may have capacity issues. So again, it's a matter of timing and planning and really preparing to do this in the right way.
Lisa, I would like to add on the first question. Andy mentioned a GM type of plan. We know of 2 jumbo plans that are in the market currently. One is slated to settle sometime this month. I would consider it a jumbo plan, or a definition of a jumbo plan is somebody that is purchasing $1 billion or more in liability. There was an interesting article that came out today in Plan Sponsor regarding the IRS private letter rulings for retirees being offered lump sums. One little mention in there said that in 2012 there were 2 of these PLRs, or private letter rulings. Those were probably associated with GM and Ford. This year there were 5 issued. So that tells me that there are 5 extremely large plans that are currently in play.
Great. Thank you, Andy and Mark. That's all the time we have for our Q&A session. So at this point, I will turn it over to Krista for her closing remarks.
Great. Thank you, Lisa, Mark, and Andy, for a very informative session. Any unanswered questions will be answered offline, just to ensure all of our audience they will be taken care of. We didn't get to everybody, I know. That will also conclude today's webinar. Thank you guys so much for tuning in. A link to our YouTube page will be emailed out to all attendees, where they will be able to view all of our recorded webinars, including this session today. Also keep an eye out for upcoming webinars featuring Retirement Income Series and more from the Pension Risk Transfer Series. On behalf of the panelists and organizers of this webinar today, thank you for joining us, and have a great afternoon. Thanks, everybody.